Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
As of the close on February 19, 2026, Hyperscale Data, ticker GPUS, is trading at roughly 19 cents. We saw 51.58 million shares change hands in a single session. This is a stock that has seen a consolidation near historical lows right after a 52-week decline of over 94%.
Yeah, and that 94% number is, well, it's the elephant in the room, isn't it? When you see a chart that looks like a ski slope, it usually tells you that the market has fundamentally lost faith in the business model. But, we're not here to write an obituary. We are here to dissect a very specific, very strange situation with Hyperscale Data, formerly Alt Alliance, formerly BitNile. The central question is unavoidable. Is this company a massively undervalued asset play trading below the value of its own liquid treasury, or is it the definition of a value trap, a siren song of cheapness driven by structural dilution and serious governance risks?
Right, and I take the view that the market has become completely irrational here. This is a classic deep value situation, perhaps one of the most extreme I have seen in the micro-cap space. When you look at the raw mathematics of the balance sheet versus the market capitalization, the asymmetry it's just staggering. We are looking at a scenario where the market is essentially valuing the operating business, the data centers, the real estate, the software, at a negative number.
And I take the opposing view. I believe that what you call value is a mirage. It's a mirage created by a deteriorating capital structure. You cannot simply look at a snapshot of assets without looking at the rate at which the share count is expanding to fund them. This isn't just about assets. It's about a history of dilution, a credibility gap with management, and a cash burn that threatens to consume whatever value you think is sitting in that treasury.
I see why you think that, but let me give you a different perspective on the numbers because they are hard to ignore. As of the February 6th, 2026 estimate, the net asset value, or NAV, per share was reported at roughly 35 cents. Yet the stock is trading at 19 cents. That is a 45% discount to the liquid value of the company. If they liquidated everything tomorrow, paid off the liabilities, and cut a check to shareholders, you'd almost double your money.
But they aren't going to liquidate.
Hold on, let me finish this point because it's critical.
Fair enough. Go ahead.
If you combine their cash and Bitcoin holdings, you're looking at $87.6 million. That represents nearly 137% of the total market capitalization. To put it plainly, investors are being paid to acquire the operating business, the Michigan data center, the AI software. You're buying $1 for roughly 50 cents. That is the definition of a margin of safety.
I'm sorry, but I just don't buy that. Let me tell you why. You are quoting NAV as if it's a static figure that shareholders can actually access. It's not. You mentioned the stock is down 94% in a year. That doesn't happen by accident. It happens because the assets you are talking about are constantly being diluted by new share issuances. We have seen this company rebrand from BitNile to Alt Alliance and now to Hyperscale, all while relying on what we call at-the-market offerings, or ATMs.
The ATM is a standard financing tool for growth companies.
It is, but here it acts as a ceiling. Every time the stock price tries to rally, the company issues new shares into the market to raise cash. It caps any real price appreciation. You cannot value this solely on a balance sheet snapshot when the company is burning cash and increasing the share count just to keep the lights on. You aren't buying $1 for 50 cents. You're buying into a bucket with a hole in the bottom.
I think you are focusing on the mechanics of the past rather than the reality of the present asset base. Let's look at the first core point of contention: the digital asset treasury versus the cash burn. The strategy here is unique. They aren't just an operating company, they are a holding company for hard assets. As of February 17, 2026, Hyperscale held over 600 Bitcoin, specifically 600.5299 BTC. At market prices, that is valued at roughly $41.3 million.
Right. And how did they pay for it? That is the question nobody seems to ask.
They are accumulating it through mining and capital allocation. Plus, they just launched a strategic silver reserve program targeting up to 100,000 ounces. This provides a tangible floor for the value. The stock price has completely decoupled from the value of the Bitcoin they hold. If you believe Bitcoin has upside, this stock is a leveraged proxy for that growth, but with a safety net of physical assets.
That's a compelling argument, sure, but have you considered the cost of that capital? That treasury isn't funded by profit, it's funded by shareholders in very expensive debt. Look at the Q3 2025 financials. They reported a net loss of $13 million and negative free cash flow of over $20 million. They are bleeding cash.
They are investing in growth, which requires capital.
They are paying for it with incredibly expensive paper. They just established an offering for Series D cumulative redeemable perpetual preferred stock. Do you know what the dividend rate is on that? 13%. They are paying 13% interest to buy Bitcoin or pay down other debt. That is an incredibly expensive cost of capital. It's like taking a cash advance on a credit card to buy volatile stocks. It negates the value of the treasury because the liability side of the balance sheet is growing just as fast, if not faster. If Bitcoin stays flat, they lose money simply on the interest payments alone.
I would frame it differently. The 13% is the cost of doing business when you are in a massive transformation phase. It's high yield because the opportunity cost is high. And that brings us to the second point, the pivot to AI and the Michigan facility. You're acting as if this is just a financial engineering experiment. But there is real infrastructure here. The Dowagiac Michigan data center is currently operating at 30 megawatts. But the roadmap? They are targeting 340 megawatts by 2029.
A target is not a reality. A roadmap is just a piece of paper.
It's not just a target. They have agreements in principle with the utility providers. They have the land. They are pivoting from self-mining to high-performance computing and AI hosting. We know that the demand for this infrastructure is insatiable right now with the NVIDIA Blackwell architecture coming online. The hyperscalers, Microsoft, Google, they are desperate for power. Hyperscale Data has the power contracts, and look at their subsidiary, Ask ROI. It just surpassed 1.3 million downloads. That is a high-margin software business growing quietly underneath the heavy infrastructure play.
I come at it from a completely different angle. I look at execution capability. Do you know what it costs to build an AI-ready facility today? The industry estimates are $8 to $11 million per megawatt. To build out 340 megawatts, you are talking about billions of dollars in capital expenditure. Not millions, billions.
They will finance it through project debt and future revenue.
With a debt-to-equity ratio of over 11? With a net debt-to-EBITDA ratio of 32.3 times? The market average is closer to 1.1? They do not have the balance sheet to compete with the big players. The only way they can fund that Michigan dream is by issuing more shares, which heavily dilutes the value you are so excited about. And regarding the Ask ROI downloads are vanity metrics. Revenue is sanity. Until we see that software contributing significantly to the bottom line, it's a distraction from the fact that they don't have the cash to build the data center they are promising.
I'm not convinced by that line of reasoning because you are completely ignoring the insider confidence. If the situation was as dire as you describe, if the dilution was going to spiral to infinity, why are the people running the company buying the stock? Milton Todd Alt III, the executive chairman, purchased millions of shares in late December 2025. He was buying heavily between 18 and 20 cents.
Insider buying can be a signal, sure.
It is a massive signal. He put real capital to work. And they are cleaning up the structure. They are divesting Alt Capital Group, getting rid of the cranes, the lending, the hotels. By the fourth quarter of 2026, this is going to be a pure-play AI and crypto stock. The conglomerate discount is going to disappear. The market hates complexity, and they are simplifying the story. Or perhaps the credibility discount will remain. We have to talk about governance here. Institutional ownership in this stock is virtually non-existent. It is less than 9%. The big money isn't touching this. Why? Because they don't trust the structure. You can't just wave away the August 2023 SEC settlement, cease and desist orders regarding misstatements, using company funds to settle personal debts. That leaves a permanent mark on a management team.
That was settled. It's in the past. But the New York Stock Exchange compliance issues are in the present. They received non-compliance notices as recently as late 2024. They had to do a 1-for-35 reverse split just to stay listed. That destroys retail sentiment. When you do a reverse split, you wipe out the share count of the average holder. And if the price drops afterwards, they are left with essentially nothing. When a company is fighting just to stay on the exchange, insider buying doesn't offset the structural risk. It feels like window dressing on a burning building.
I think that is overly cynical. Every turnaround looks like a disaster until it actually works. The SEC settlement was a hurdle, yes, but they paid the fines, they hired the consultants, they are moving forward. The reverse split was necessary to maintain the listing, which preserves the liquidity for all shareholders. You are punishing them for fixing the problems. The fact remains, Todd Old bought the stock. He sees the math, the assets, the Bitcoin, the silver, the data center capacity. They are real. If the market wakes up and realizes that the cash on hand is higher than the stock price, the re-rating could be violent.
Violent is the right word, but perhaps not in the direction you hope. Let's look at the technicals for a moment. The stock is pinned under 20 cents. The 200-day moving average is all the way up at $1.29. That is a mountain of overhead supply. Every time the stock ticks up, there's that ETM machine, the at-the-market offering, selling shares to pay for the 13% dividend on the preferreds. It acts as a gravity well.
But look at the volume. 51 million shares in a single day. The retail interest is absolutely there. The beta is extremely high. The stock moves with Bitcoin. If Bitcoin breaks 75,000 or 80,000, the value of their treasury expands immediately. The NAV goes up. The discrepancy becomes even more absurd. You cannot keep a stock trading at half its liquidation value forever. Eventually, an arbitrager steps in.
Unless the liquidation value is consumed by operations before that happens. That is the race we are watching. It is a race between the appreciation of the Bitcoin and the cash burn of the data center. And right now, the cash burn is winning. They had negative operating margins of almost 58% in Q3 2025. You can't arbitrage a burning pile of cash.
It's not a burning pile of cash. It's a targeted investment in capacity. They have the DTE electric contracts, 19-year minimum durations. That is stability. That is a tangible asset that can be monetized or borrowed against. The Michigan regulatory environment is favorable. They aren't just building in a vacuum. They are building where the power is already secured. In the AI world today, power is the new gold, and they have it.
Having the contract and having the money to build the facility are two very different things. They have the permission to build, not the capital. And to get the capital, they have to dilute you. That is the circle we keep coming back to.
But that dilution is already priced in. At 19 cents, the market is assuming total failure. That is my point. The bar for success is so incredibly low. They don't have to become Amazon. They just have to survive and build out a fraction of that capacity. And the stock is a multi-bagger from these levels.
Or they continue to execute reverse splits, and the 19 cents becomes the new $19, which then naturally drifts back down to 19 cents. We have seen this exact movie before with this ticker.
That's an interesting point, though. I would frame it differently. The past creates the opportunity. Because investors are scarred by the chart, they are ignoring the fundamental shift in the business model. The divestiture of the legacy assets, the cranes, the lending. That is the catalyst. Once those are gone, the financials become clean. It becomes a very simple story. Here is our Bitcoin, here is our data center, value us.
I genuinely hope you are right for the sake of the retail holders. But the sum of the parts argument rarely holds up when the governance is this messy. The complexity of the conglomerate was a shield. Removing it might just expose how expensive the core operations really are.
Let's wrap this up. I look at Hyperscale Data and I see a mathematical anomaly, a net asset value of 35 cents, a stock price of 19 cents, a treasury of Bitcoin and cash that exceeds the market cap. Yes, there are risks. Yes, the history is volatile. But you are buying $1 for 50 cents. The margin of safety is huge. The assets are real.
And I look at it and see a financial engineering machine that runs on dilution. Cheap can always get cheaper. The 13% dividend on the preferred stock is a ticking clock. The billions needed for the Michigan build-out are a mountain they haven't even started to climb yet. The sum of the parts simply doesn't matter if the share count keeps exploding. It's a high beta gamble, not a deep value investment.
Well, we can definitely agree on one thing. This is a high beta proxy for the AI and crypto sectors.
Absolutely. If you want leveraged exposure to those themes and you don't mind the massive governance risk, this is certainly one way to get it.
The crucial watch point going forward will be the upcoming audited financials and the progress on those divestitures. That will tell us if the pivot is real.
Indeed. Is this a legitimate infrastructure turnaround or just another chapter in a long story of capital destruction? The market remains highly skeptical, but the assets are certainly accumulating.
And that is where we leave it today.
Until next time.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.